Hello everyone. Today we will learn about weighted average cost of capital and the most common mistakes that people do while calculating it. But before we proceed, let's see what all will be covered in this video and its order. We will first talk about the definition and computation of WACC. Then we will talk about a key concept of finance, which is over and under investment. And finally, we'll look at four technical points or the most common mistakes that people do while calculating WACC. So let's start with the cost of capital. For a business or project to run successfully, it has to be adequately financed. Providers of fund expect to be compensated for the risk that they are taking by putting their money in that project or company. Cost of capital is nothing but the weighted average of the minimum returns that each of that investor expects from the business, where weights are the market value of the investments. So, for example, in case the debt and equity are the two sources of funds, the WACC can be written as following, where KE is the cost of equity, KD is the cost of debt, D is the market value of debt, E is the market value of equity, and V is the summation of market values of debt and equity. As a thumb rule, companies should only invest in a project whose return is more than the cost of capital, as only then it will be able to generate profits and hence create value. Now let's understand the concept of over and under investment. When a company rejects the project that can add value, which means that the return from the project is higher than the cost of funding the project, and even then company rejects it, it is said to be under investing. On the contrary, when the company takes a project that destroys value and is loss making, it is said to be over investing, as in this case the cost of capital is much higher than the return that the project will provide. Let's now talk about the technical points or the common mistakes that people do while calculating WACC. The first one being pre-tax cost of debt versus the coupon rate of the bond. Pre-tax cost of debt is defined as the interest rate that is expected by the investors now. It is the rate of interest that a company has to pay currently if it borrows the money. It is not the coupon rate that the company is paying on its existing bonds. Thus, for example, if a company has borrowed money last year at 10%, then its pre-tax cost of debt will be 10% only if it can borrow currently at 10%. If the lenders lend to the company only at 12% now, then the pre-tax cost of debt is increased from 10% to 12%. Let's assume the following numbers of a company to explain this process. The cost of debt is 10%, the cost of equity is 20%, debt to equity ratio is 1:1, the tax rate is 30%, and the coupon rate on debt is 5%. The true cost of capital using the formula of WACC that is provided earlier comes out to be 13.5%. Here, I have used the cost of debt and not the coupon rate of debt. However, if I replace the cost of debt with the coupon rate of debt, I'll get the incorrect WACC of 11.75%. Now you may wonder what is wrong with the 11.75%. The reason why 11.75% is the wrong cost of capital is that it may lead the management to take the wrong investment decisions. Thus, for example, what will management do if it gets the project that promises a rate of return of 12%? If the management uses the wrong cost of capital, it will end up accepting the project, however, it will destroy the value. Hence, the true cost of capital that the company should use always is with the cost of debt and not the coupon rate of debt. Hence, in this case, 13.5% is correct. Next, let's look at the cost of equity versus the dividend yield. Cost of equity is defined as the minimum return the shareholders require from their equity investments in the company. This required return has two components, namely dividend and the capital gains. One should not define the cost of equity as only the dividend yield because this definition completely ignores the return expected by the shareholders from the capital gains. The biggest problem with defining the cost of equity as a dividend yield is that the dividend yield for most of the companies in the world is extremely low. If a company defines its cost of equity as a dividend yield, then it will invest money in the projects giving extremely lower rates of return. This is a sure recipe for overinvestment by a company. You can see in the above table mentioned that more than half of the listed companies in India do not pay any dividend at all. Now, if we define the cost of equity in this way, the cost of equity will come out to be zero. This will give them a justification for investing in practically any project and what will lead after it is a big blunder. The next technical point that we'll talk about is the weights in the computation of cost of capital that must be the market values and not the book values of debt and equity. When we compute the cost of capital, we compute the debt equity ratio by dividing the market value of debt with the market value of equity. That is the only definition that is consistent with the shareholders' wealth maximization objective. Investors pay the market value of equity to invest in the equity of the company. Therefore, they expect the return on the market value of their investment and not the face value of the share. Let's illustrate this point by taking an example. The cost of equity is 20%, the cost of debt is 10%, the tax rate is 30%, the market value of equity is 120 million, the book value of equity based on the face value of share is 16 million, significantly low, and the market value of debt is 60 million. Here, one must compute the cost of capital by using the market value figures, which come out to be 15.67%. Instead, if we use the book value of equity numbers, we get 9.736%, which is significantly lower than the true cost of capital. Now, again, as an exercise, let's suppose that the company gets a project which promises a return of 12%. What will a company do? I think you know your answer by now, and it's clearly marked on the screen. Now, what happens if the market value of debt is not available? Most of the Indian companies do not have a correct market value of debt assigned to them, clearly because they are heavily dependent on banks and financial institutions for their debt capital. And it is not possible to obtain the market values of debt in such cases. Secondly, even when the companies have issued bonds and debentures, one cannot obtain the market value of debt using these bond instruments that do not trade actively in the market. Hence, most of the consultants end up advising the companies to use the book value of debt instead of the market value of debt. However, this leads us back to the square one where we get incorrect cost of capital instead of getting the correct one. Now, assume that we are valuing a troubled company. We certainly cannot assume that the book value of debt is equal to the market value of debt. We have to estimate the market value of debt by discounting the coupons and the principal payments using the pre-tax cost of debt. This obviously is a more complicated method, however, is much required if someone has to do the valuation in its true form. The last technical point that we'll talk about is the discount rate and should it match with the riskiness and the type of cash flows. One of the main fundamental principles of DCF valuation is that the discount rate must match the riskiness of the cash flows being discounted. Now, people often tend to misuse this and get the wrong values on their valuation. They normally forget doing this in two scenarios. First, when they discount the nominal cash flows using the nominal discount rate, and second, when they forget to use the rupee cash flows to discount the rupee discount rate and US dollar cash flows to be discounted at the US dollar discount rate. If we keep the riskiness of the cash flow and the discount rate constant, we'll always get the correct valuation figure, assuming every other thing is kept in check. Thank you, and do join for more videos.